Gold, government bonds, the US dollar. They're safe, right? That's why they're called safe havens. But today's environment is challenging that reputation. So, are traditional safe havens still safe? It's the Money Talks podcast with me, Andrea Heng. Now, we've been long taught to retreat, to flee to safe havens when markets turn red. But if you're looking at your portfolio right now and thinking to yourself, hey, why aren't these performing the way they should? These should be performing way better than they are right now. You're not the only one asking this question. Here to explain why is Sani Hamid. He's Director of Economy and Market Strategy at Financial Alliance. Hi, welcome to the hot seat.
Thank you for having me.
Sani, a safe haven asset is supposed to be the shield in our investment war chest. What is the secret sauce, first of all, that makes them so secure?
As you mentioned, there are a few traditional safe havens. Gold, for example. If you talk about gold, it's the scarcity, the limited supply of gold. No one country is in charge of gold, or rather, it's not like a currency.
That's right.
US dollar and so on. So you don't have what we call a counterparty risk when it comes to owning gold itself. So it's a safe haven from that perspective. Scarcity and counterparty risk. The US dollar, strongest economy, strongest militarily, and so on. Same thing with US government bonds, deepest market, most liquid market. And so people tend to run to these kind of safe havens traditionally in order to get away from the volatility, as you mentioned earlier.
Is this because of the sheer volume that they have and therefore there's more to go around?
Yes, it's correct. I mean, for example, I just mentioned about the bond markets itself.
Yes.
If one wanted to unload a couple of million, 100 million, 200 million, that would be the only market in the world today which will be able to absorb that kind of quantity. If you do it in other markets, it will move the market. That's not really what you want.
Okay, good point. So let's talk about the first safe haven asset on your list, and that's gold. Gold has been dominating headlines for many reasons for most of last year and this year. And it happens to be the first asset that comes to mind when we think about safe havens. But a crisis has just broken out and gold prices fell. So it's obviously a divergence from what it's supposed to be. Why?
Okay. I think we have to understand that basically different crises have different characteristics.
Okay.
And therefore, not one safe haven universally can be applied to all crises.
So it's not a template.
It's not a template. So one has to kind of craft individually. Certain safe havens will be more suited for certain crises, for example. The current crisis itself, prior to the crisis, or at least prior to the Iran-US war itself, we had already seen gold going up. Central banks were buying, people were putting gold into their portfolio and such. So it's been doing quite well over the past 12, 18 months. And so when the crisis hit, what happened was basically you found that certain countries, especially in the Middle East, so the Middle Eastern countries itself, revenues literally fell off the cliff because they couldn't export oil, which is the main revenue driver for Middle Eastern countries.
Correct.
And so if you're in a situation where revenue falls off the cliff and you need dollars because you need to run your economy, you look into your portfolio and you find what's been doing well, how do I raise money? You sell assets, basically.
So you sell gold. So they were selling gold.
So they were selling gold. So we find some central banks selling gold because of that. We find some central banks in emerging markets selling gold because their currencies have started to depreciate and they need to defend their currencies. And so where do I get dollars to sell to buy my so-called local currency itself? I sell gold, get dollars, and then I intervene in the foreign exchange market. So gold has, for lack of a better word, done its job, i.e. been that steady gainer within the portfolio, and now kind of suffers from being too successful.
So it's become a victim of its own success.
Exactly.
So that means what the central banks had been doing all this while, collecting all this gold, driving prices higher, this is the time that gold shines as a hedge.
Exactly.
It's proven its use.
Exactly. So if you look at it and it's not gone up, and the reason is its own success, basically.
Okay, wow. I never thought that could be a picture that I can attach to gold. So if I have gold in my portfolio right now, what are my options?
It depends on what type of investor you are. Okay. We do know that basically short-term investors who have leverage and so on, some of them find their existing portfolio, some part of it underwater. Some of them get margin calls from their bankers and so on because they've gone on leverage, And so again, these will be quite similar. Dispose of the gold, get the money, offset some of the losses that I've seen and so on.
Right.
Some of them who are longer-term investors would keep gold in their portfolio because they know over time, this is my diversifier, this is my insurance and so on. And gold does go up over time. And so this will help me to offset some of the volatility in my portfolio. So it really actually depends on what type of investor you are.
Right. And really how you view gold as an asset, because if you're thinking long term and if you're thinking of it as a hedge, and if you think about what you said earlier, the scarcity of the resource, that might keep you invested for the longer term, right?
Yes. So there's always this core holdings, i.e., let's have about 3 to 5% in gold itself. That's core. Tactically, there could be reasons to own more than that at certain phases or certain parts. Like, for example, maybe after this, after we move through this cycle that we're currently in from what we call an energy and food crisis, we move into a situation where we start to see cracks in the global economy. People become a bit jittery.
Yeah.
Then people will start increasing that core holdings into what we call more tactical holdings. We saw that during the 2008 crisis.
Yes, that's right.
When gold went up very much. We saw that during the European banking crisis.
Yes.
In 2010, 2011, gold went up a lot also. And those were tactical increases in gold because it was a financial crisis. People were worried.
All right, so that's going to be the sign. And that obviously means that gold prices will go up once people start tactically holding on to more of it. Okay, so if I'm calculating this right, that leaves me with cash.
Cash traditionally has not been considered to be a safe haven unless you come to a point where some of the other safe havens are not that safe in a way.
How do I determine that then?
Because when you, for example, if I look at gold today, and as we correctly interpreted it, people are selling it because of certain reasons we've mentioned.
Right.
If I look at the US Treasuries today, yields on US Treasuries have actually gone up, which i.e. means the price of US Treasuries have gone down instead of it being a safe haven.
Right, because a yield is that gap.
A yield is yields and prices of bonds actually are inversely correlated.
Okay.
So when yields go up, bond prices go down.
Right.
And US Treasuries, one would expect during a crisis that the Treasury prices would go up, yields would come down. It's now the opposite.
That's right.
And that's related to the fact that the US has this massive amount of debt. And so that means, i.e., I need to issue more treasuries in order to finance my debt.
Right.
And so people are a little bit more kind of like hesitant to treat treasuries as its pure safe haven as they used to the last time. Because at 120% debt to GDP in the US itself, people are starting to say, are US treasuries that safe credit from a credit perspective?
Right.
Okay, so in this scenario where gold, treasuries and such, they're not functioning 100% as they should be, maybe putting money in cash is probably something not a bad idea, even though the returns are not very high.
Right, but it feels safer. It's the perception and the sentiment that it gives,
and
right?
investors must realize that at times you want to make as much money as you can, naturally.
Of course.
But there are times where not losing money is making money.
Yes, correct.
Yeah,
mitigating factors, right?
Exactly.
So you talked about the debt to GDP ratio for the US being at 120. What would be a comfortable level then to tell myself, okay, I think this is a comfortable level for me to start buying back into treasuries and bonds?
We've passed that point.
Oh, wow.
Historically, 100% of GDP has been that level where people start to worry once you cross that level.
And the US has way crossed that.
Way crossed that. And one can also say that there are reasons why it can sustain it because the US dollar is a reserve currency, the US economy is the strongest economy, and so on and so on and so on.
The things that contribute to US exceptionalism.
Exactly. But you can't move away from the fact that it's high.
Yeah.
We've seen credit rating agencies starting to lower down the credit rating of the US. We've seen the yields go up, which tells you that people are beginning to transfer a bit of that risk. If you want me to buy a bond, if you want me to lend you money, I will, but at a higher interest rate.
Yes, give me a higher premium for
exactly.
sitting with that risk, right?
Yeah, exactly.
Wow, okay. So obviously and this is in relation to what we just talked about, the status of the US dollar being questioned as a safe haven asset, right? Are people right to question that status?
Well, judging from what we've seen, the US dollar's safe, or rather reserve currency status is eroding. We don't think it's going to overnight lose that status itself. But it is gradually, quite clearly, on a downtrend. People are now trading in oil, in Chinese yuan. We have even, I think, news that some of the ships going past Hormuz being paid in the fees are being paid in Bitcoin, and stuff like that. And so we are seeing signs that there's a lesser use of US dollars in transactions being undertaken, and that actually started or accelerated, let me put it that way, after the Russian-Ukraine war.
That's right.
Because the US started to seize assets denominated in dollars, assets that were in dollar systems, banking systems. And so back then, if you were a foe, meaning to say if you were not in the good books of the US administration, you would then you would have wanted to diversify. You would have been diversifying away from US dollar denominated assets. But today, even friends, so-called allies, friends themselves, are now thinking maybe I should also diversify away from holding exceptionally a lot of US dollars.
So what then defines a safe haven currency?
So we're getting to a point where it's going to be very difficult to then say this particular currency, this particular situation. So it's a bit like the oil situation today. It used to be that let's buy from the producer, one single producer, because we're going to get a huge bulk discount and so on.
Yes.
We're going to move away. Every country is going to move away from that because the supply security question will come up. And so we don't mind buying from various sources, even though prices are higher. So bring that back to the FX side. We don't mind diversifying into yuan, into euros, into Swiss, into Sing dollars and such, rather than keep everything in one basket, i.e. the US dollar.
I'm secretly proud you mentioned Sing dollar. It's been touted for a while amongst many people that I speak to that the Sing dollar is gaining that recognition and status as a safe haven currency. But Singapore is very small. And that means our volumes traded are quite limited, right? So there is that, am I on the right track? There is a limiting factor to Singapore dollar being, restricted in how safe haven a currency it can be.
In a way, it's restricted by the depth of the markets, i.e. it's not deep enough to absorb whatever comes. You can't put everything that's coming your way. It does have the classic characteristics of a safe haven, a very strong political, strong economical, fiscally very strong, the only one of the few AAA countries in the world. And so all of this add together makes it a kind of de facto model for a safe haven currency. Right. But the market's not deep enough to absorb every single thing if the global world, investing world tries to pump everything into it.
So it's a good but not so good position to be in.
A limitation.
Okay. Could we then be entering a new world where, and we hear things like new order all the time, could we be entering a new world where there can be more than the safe haven currencies we have now? So right now in the basket, it's the US dollar, it's the Swiss franc, it's the Japanese yen, Sing dollar can be in there as well, among many others. Could we have a wider variety now? I know China has been pushing to have the yuan in that basket as well.
Yes, absolutely. I think we're definitely headed towards that situation today. So the biggest question, of course, is who comes out stronger and so on. So I guess it goes back to central banking 101, i.e. Central banks hold reserves. Central banks will want their reserves to reflect what reserves are foreign currencies that a country holds.
Yes.
And typically you want them to be like 3 months worth of trade or imports and such, because anything happens, you've got the foreign currency to buy imports.
It's a good buffer to have.
It's a good buffer to have. And so it should reflect the composition of your trade.
Yeah.
And so if you have a massive amount of trade with the US, then your reserves typically would be slightly bigger, more towards the US. Now China and so on. So I think people are just going to go back there and say, okay, let's kind of diversify across and hold these different currencies according to what we really need, rather than just lump everything just because it's called international reserve currency. It's safe. Let's go everything all in. I think we're past that point.
So it's kind of like the benefits of owning a multi-currency wallet, essentially.
Yes, diversification will be the key word going forward, whether it's holding of foreign currency or reserves, whether it's oil, whether it's food supply, security, whether it's energy. So everything itself from now onwards, let's not be vulnerable with respect to one source. Let's have multiple sources, and that would probably entail higher costs.
The other currency that we must talk about is the Japanese yen. Now, the Japanese yen falling to record lows over the last few years and such, which is why a lot of Singaporeans are so happy to go to Japan for holidays. That's caught everyone's attention for right or wrong reasons, for good or for bad. What's your current assessment of the Japanese yen as a safe haven currency right now? Should I be stocking up because it's come down? Can I still call it a safe haven asset? A safe haven currency?
I think that's the question.
That is the question. Yeah.
Because in the 1990s, the yen was considered to be a safe haven, or at least a very strong currency itself.
And it led everyone to have faith in that Japanese economy. Yeah.
Again, strong economy, strong currency. But since then, when the Japanese rates went all the way down to zero, negative at some point, the yen started to change its characteristics and became a so-called funding currency.
What does that mean?
A funding currency means a currency that you borrow in order to invest elsewhere, because borrowing rates was you basically borrowed yen at zero interest rates, converted it into another high yielding currency and invested somewhere else.
This is the carry trade.
Exactly.
Okay.
The carry trade.
Got it.
And so it kind of lost a little bit of its safe haven status, because it kind of changed characteristics to be a funding currency itself. And you've seen the yen weaken in almost a straight line in recent months and years. And that's not really a good characteristic of a safe haven. You're literally losing money on it. You're putting money there.
Is it at the point of no return though?
It depends.
Okay.
It really depends. I mean, there are a lot of moving parts now. One could make an argument that the yen could bounce back once the BOJ starts to raise rates, differentials with the US starts to narrow and such. One could make a counter argument to say that it will continue to weaken. So this uncertainty itself will tell you that safe haven,
Yeah, it's a very, I don't think...
A little bit is okay, but no.
Yeah, it's almost as if, and this is like the theme of our conversation, right? It's almost as if the term safe haven itself is not safe anymore. It feels that way, right? It's on shaky ground.
It's dynamic. So I'll give you a very good example. Today, in the Iran-US situation, what's the current safe haven now? So if my theory is we are now undergoing what we call a food and energy emergency, which potentially could evolve into a crisis, a food and energy crisis, as this thing continues, because it's dynamic, it's not static, it's continuing. And so one would think putting some hard and soft commodity assets or investments into one's portfolio would be a nice buffer, a nice safe haven, because if we move down this path and we do eventually reach a crisis level, this is the portion of your portfolio which is going to help to buffer the other side. So for now, for this current situation, temporarily, those are your safe haven.
Okay.
Will they be permanent? No, because when demand destruction comes in, when the economy starts to slow, the first thing that will go down is demand for oil, demand for commodities. Your safe havens will start to turn.
And that's what you mean by dynamic.
Exactly.
So we as investors, retail or not, have to think of safe havens in a very adaptable manner.
Exactly.
Right. We have to be nimble like we do with our equities.
Yeah. And so then the second phase is, so when you see a global downturn in growth, stresses coming up in various economies, various part of the economy, because we've been growing so fast, suddenly we're coming to a halt.
Yeah.
Then we ought to be changing the safe havens, because then gold comes in, because under this kind of economic stress, everybody flees. Let's go to somewhere. So it's kind of like a dynamic situation.
Yeah. I think the saying here is this: safe havens can't rest on their laurels anymore.
Exactly.
You just can't stay static anymore. So how then should we as retail investors readjust or manage our savings if we don't feel like flocking to safe haven assets?
So historically, there are investing philosophies that say you should ride through the cycle. Ride through the cycle means basically you correctly design your portfolio to suit your risks, add in your necessary safe havens, add in your necessary exposure to equities, add in your necessary exposure to fixed income.
Yes.
Okay. And if you hang on to this and you don't need to tinker with it, at the end of the day, it will come out fine.
Yeah.
And historically, that's been the case.
You literally bite the bullet and just
ride through the cycles.
Yeah.
Because markets are, of course, cyclical.
Yeah.
But the point B is always higher than point A. We just look back at all equity markets. As long as you've been diversified, think back 10 years, 20 years, 30 years.
You've definitely gained
gained.
Yeah.
Okay, as long as you get your compositions correct based on your risk profile.
Okay.
So that's one way of looking at it.
Okay.
Yeah. But there are, admittedly, investors are sometimes a little bit more shorter term focused. They worry about the next 3 months, 6 months, and
because
so
they
on.
want to try and optimize as much as possible, right?
Yes.
Without
and,
losing.
And not everybody can sit through a 20-30% decline.
Yeah. It's hard to stomach. It's hard to stomach. I can't blame them. Yeah.
So then you need to do what we call go underweight, take off a little bit of volatility, equities, put in a little bit of diversifiers, like I mentioned, maybe some commodities in this particular situation, kind of trying to reduce that volatility of your portfolio so that if the downturn comes, you kind of absorb some of the shock. Not totally, but you take some of the shock off the volatility.
Right. It's just to help temper any of the big shocks.
Swings.
It helps you sleep at night a little bit better too. Okay. So just want to quickly go back to the bond story here. Because there are all sorts of bonds locally here in Singapore, in the US as well. And there are different types of bonds. There are government bonds. There are investment grade bonds in the private sector as well. So a lot to think about. In times of crisis, what would your advice be for the average investor as it pertains to bonds?
So we have kind of advised our investors, say, for example, if you're in the fixed income markets, try to move to the front end. Okay, meaning to say shorter duration, shorter term bonds for in a layman term.
So these are 5
years and below.
Okay,
Even
6 months.
As front as possible.
Okay.
And the reason being, technically speaking, if you're on the longer term, higher duration, if interest rates go up, it's more sensitive. For 1%, for example, 1% increase in interest rates will cause a multiple time decline in that bond. You don't want that because we think interest rates are potentially could be headed higher if inflation goes up, food inflation, energy inflation. Interest rates go up, your more sensitive back-end bonds will suffer more. So you try and run away from that to get into the front end. That's number one.
Okay.
Number two, if you're a local investor, a Singapore government bond is risk-free. Government is considered to be risk-free. Okay? If you try to do the same thing in the front end with a US Treasury bill, for example, you will be exposed to the currency risk.
Yes.
So you want to get away from that.
Okay.
Yeah. So there are few things you can do to try and kind of like get away from the situation.
Right. Stay far away from the fire as possible. Okay. So for the investors who want to bite the bullet, ride the wave, this is just another crisis, we'll ride it out, it'll be fine in the end. What do they need to be prepared for?
So if they can literally say that out, means to say they are expecting volatility to set in. Okay. I.e. they would expect markets to potentially or their investments to potentially go down. We have such investors, and those investors tend to look at markets differently. Right. They would say that when the markets decline, it's an opportunity for me to buy more because it's cheaper.
Yes, buying the dip.
Buying the dip. Because they know and they are quite convinced that further down the road, the markets will recover. I should see any decline as an opportunity. It's the old way of what people say, when there's blood on the streets, that's when you come in, or when people are greedy, then you should be fearful. When people are fearful, then you should be greedy.
Dear Warren Buffett.
Yeah, dear Warren Buffett, exactly. Yeah. So there are investors who adopt that strategy, which I think is very good.
Well, at least you gave us some solid ground on how to read where the safe havens are right now. The takeaway here is that it's dynamic, it's moving. We need to keep moving along with it. Thanks very much for that, Sani.
Thanks for having me.
And to you, our Money Talks community, thank you. I hope you found that beneficial. I learned a lot today. But I want to ask you now, and please leave your answers in the comment section or wherever you are listening to us from. The question is, has your trust in traditional safe havens now been shaken? Let us know once again in the comments wherever you're listening to us from, or you can email us, cnapodcasts@mediacorp.com.sg. This has been the Money Talks podcast. My name is Andrea Heng.